Herkese merhaba. Bugün tahvil piyasalarına özel bir parantez açıyoruz. Aslında hafta başından beri uzun vadeli tahvil faizlerinde yükselişi konuşuyoruz. Amerikan hazinesinin piyasaya müdahalesinden söz ettik. Tahvil piyasasında tam olarak ne oluyor ve Amerika'nın müdahalesi neden işe yaramadı? Waverton portföy yöneticisi James Carter'la buluşuyoruz. Hi James, it's great to have you with us again.
Thanks for having me on.
Whenever we speak, there seems to be some turbulence in the markets. There is this US Treasury buyback and short-lived relief. Why do you think this long-term bond yields risen so sharply, and why did the US Treasury's intervention fail to bring them down?
There have been two key factors here. One has been the inflation backdrop, which clearly has become more complicated and uncertain due to the Iran war and how long the Iran war has continued to go on for, with increasing uncertainty as to when there's going to be a resolution there. But the second factor, which is really driving markets in recent weeks, is the scale of the fiscal deficits, how that is due to be funded, the unpredictable nature of both fiscal policy and actually more recently monetary policy with the new Federal Reserve governor. And that has driven the term premium on US Treasuries, so the difference between short dated yields and very long dated yields, to rise as investors have effectively demanded greater compensation for lending to a government running such unstable, one could argue, borrowing plans and fiscal deficits.
So, what will happen from now on? I wonder. Why was it short-lived, the intervention of US? And can we say that the intervention is being driven by domestic politics rather than market functioning?
It's it's an exceptional period of time to see the Treasury, particularly, and not the central bank, intervening in the markets in the way that it has. They have been, in a more passive way, conducting a form of yield curve control for some time by issuing not only bonds across the curve and at the long end, but focusing the issuance of debt at the very short end of the curve, effectively not locking in current what they would perceive to see as high interest rates for the long term and funding at the short end of the curve. They would have hoped that the lack of supply at the long end of the curve would have led to stronger performance for those bonds. And those bonds are politically important because the mortgage market in the US is fixed at the long end, 10 years, 20 years, 30 years even. So they want to keep those interest rates low, and therefore for the voting public in the United States, that would be politically helpful to the administration. So Treasury Secretary Scott Bessent has effectively been announcing more Treasury buybacks. That is the intervention that we've heard this week, and there are possibly going to be further measures, maybe a greater level of buybacks to address the elevated borrowing cost. And as you say, initially that was a welcome announcement from the market, but that rally has now faded as investors effectively conclude that the scale of those buybacks is just too small relative to the amount of Treasury debt outstanding and the amount of future issuance that's going to come. So Besson really, more than most, should be very aware of the effect of one-off interventions and whether they're going to be enough or not. He was actually involved with George Soros back in the 90s, famously intervening and shorting sterling markets, and they made significant returns from that. So in isolation, those buybacks may simply be a first step rather than the end game. And maybe this is the beginning of what the market could call the Bessent put, just like what we saw from Mario Draghi in the Eurozone crisis, this kind of whatever it takes message in terms of controlling the yield curve and making sure that it's not going to uncomfortable levels. But historically, this, I think, is a concern, particularly in this nature where we're not in a recession. We're not in a deflationary environment like what Japan saw when they were intervening heavily in the market. This is a time of relatively strong growth. And if this is the period where you need to be intervening in the treasury market, I see that as a concern for the stability and policy credibility of the United States government.
You reminded us about the 1990s when Besant was sitting on the other side of the table and there was a big fall in the sterling, the pound. What happened then? Could you please remind us a little bit? Because he knows the markets very well. We can understand that. So, what he's trying to do now, maybe we can understand better if you remind us that example.
So, Besant was running the London office of George Soros's hedge fund. and was seen as the man on the ground effectively in Europe to monitor and proceed with that policy of shorting the euro, where at that time the United Kingdom government was intervening sizably with trying to protect the value of the pound sterling. And the hedge funds, including Soros's fund, which Besant was working in, saw that as an opportunity where they could test and continue to test the ability of the UK government to control sterling under the exchange rate mechanism at the time, and subsequently it broke away, and that led to, I believe, around $1 billion profit for that hedge fund. So he will be well aware of currency, the impact of intervention, and how consistent you have to be to successfully intervene. And what we've seen so far, not only in the interventions of this week, but in recent weeks in Japan as well, where they intervened to try to strengthen the Japanese yen, that again faded very quickly because it was not seen as a significant enough long-lasting policy to enact a proper change. So that's why I believe if we're going to give him the benefit of doubt, that this may just be the start of his kind of seeking further policy tools to get treasuries back to more palatable levels.
So this is like the first step of the other steps, a big maybe intervention of the first step. And JP Morgan's James Sullivan compared this Treasury's approach to paying your mortgage with your credit cards. So maybe, I don't know whether you think, is that a fair analogy? And what would a genuine long-term solution require? And do you think that for the autumn period, the risks are accumulating?
Yeah, my concern is that using forms of yield curve control, yield management to fund day-to-day deficit spending while growth remains, as I said earlier, relatively resilient would be a very different proposition to the emergency interventions we've seen in the textbooks of economic history. It's a very simple solution, which is to cut spending or raise taxes that some governments across the world have understood, but most governments, it's clear to say, have not been taking seriously over recent years. And the answer is very clear, but I'm not sure if there's enough political willpower at this time. And it's not just a Republican problem; it was a Democrat problem as well, with President Joe Biden, who could have reduced the deficit, but indeed chose not to. So the market is clearly getting concerned that deficit levels in excess of 7% of GDP at the moment have no clear path of coming down, like they do in, for example, the United Kingdom under the fiscal rules, where they are mandated to come down over time. The market doesn't necessarily believe that's going to be the case, but at least there's a framework there for that to occur. That just doesn't exist in the US. So it's clearly a concern. And at the moment, the US benefits from this concept of exorbitant privilege, which basically keeps its term premium, the difference between the short and long dated bonds, pretty muted versus other countries like Italy, like France, like the United Kingdom and elsewhere. And the more they test with these unorthodox policies, with questions about their credibility, with uncertainty on the fiscal side, that exorbitant privilege will be stretched and strained. And the term premium is likely to continue widening over the months ahead, unless he really intervenes with much more rigor than what we've seen so far.
James, are you concerned about what might happen in the bond markets and even in the equity markets for the autumn period? And do you also think that there's something to do about the central banks? Do you expect any coordinated attempts? Because we have seen one between Japan and US, and they sold euro actually to intervene in the yen, but still it was again short-lived. So what might happen in terms of governments and central banks? Do you expect coordinated steps? And are you concerned? Do you think there's something alarming in the markets for autumn period?
I do believe that the key consideration, particularly for bond markets, is going to be inflation. Over time, inflation is going to and always has been the key driver for bond markets, and the transmission mechanism of inflation leading to tighter or looser monetary policy or interest rates. So when we think about inflation and what's been driving the resurgence in recent quarters, it has, of course, been the Iran war and the flow of traffic through the Strait of Hormuz. So as we look ahead to the autumn, a bull case would see some peace deal and the free flowing of traffic. That at this point in time is highly uncertain. So we are likely to see an environment where inflation remains slightly above where we were expecting it to be a few months ago. Now, for central banks, they may choose to look through this and think that if a peace deal comes soon enough, that will lead to inflation coming back down to target. Because actually, under the bonnet, under the energy price spike we've seen, underlying inflation measures have been relatively tame. And this is a very different scenario to 2022 when we saw Russia's invasion of Ukraine, where inflation drove much higher based on a number of factors, not least the state of the labour market, which at the time was very tight, and that led to a labour price spiral, wage price spiral, sorry, leading to higher inflation. That set of factors is not in place today. The labour market is much more loose. There's much lower labour demand. So we should, and central banks should be able to look through the current inflation environment, and absent a worsening of the situation in Iran, we should see central banks either stay on pause or maybe do an insurance hike. In the treasury market may look to do that since it's already very much priced in to the curve. So in that scenario, I'm seeing the months ahead being a relatively range-bound environment for yields, where you see very little prospect for cuts. Growth has been okay, but inflation is just going to remain stubbornly high. But little expectation of material hikes because those second-order inflation effects are not quite there. So for bond markets, it's going to be about clipping your coupons, generating your carry, and hoping for no material worsening in the inflation outlook. And for equities, so far they have shrugged off the higher interest rates, which clearly affect valuations of equity markets. And that's probably been justified based on just how strong earnings have been coming in for the last couple of quarters. Operating margins are at almost record highs across most sectors, and it does pay to stay invested in that market and probably maintain an underweight to the fixed income space. And one space where we do think the interventions that we've seen this week are likely to benefit is gold. And we are seeing some action in gold, some weakening in the US dollar, because these are things that generally stand to benefit when people start to question that exorbitant privilege that the US has and how much US dollar reserves and treasury reserves they are keeping in their own central banks globally.
So what do you expect the gold can see on the high end?
I've been in this game too long to be to be giving particular targets, but we certainly think both from the spot gold price, which has obviously suffered a weakening from its highs several months ago, now is beginning to look attractive again, and also some of the gold mining companies that are a kind of a leveraged bet on that commodity price are also looking somewhat attractive at this level. So that's one place where we're looking at allocating to, in addition to maintaining fully invested in the equity sphere while this the turmoil in the treasury market takes place. I'm not sure I would want to put on my cape and start buying 30-year treasuries at this point, because as I said, that term premium still isn't quite elevated enough versus some of the global peers to be sending a buy signal to me.
James Carter Waverton, thank you so much for joining our program.
Delighted to be on. Thank you.